Every creditor wants to be repaid. That is the first rule of lending, except when they don't. For 300 years, the most powerful institutions on earth have built a system that collapses if debt is ever repaid. You are watching a negotiation. London, 1694. A Scottish merchant named William Paterson sits across from the English treasury. England is at war with France. The treasury is empty. Paterson has a proposal. He will raise £1,200,000. Immediately. One condition. The principal will never be returned. No final repayment. No end date. Interest only. Forever. The English crown says yes. Debt was not designed to be repaid. It was designed to be permanent. Paterson did not sell England a solution. He sold them a mechanism, one that would spread to every major economy within 2 centuries and reshape what money itself means. To understand what Paterson changed, you have to understand what came before. Ancient Mesopotamia, 3000 BCE. Rulers watched what happened when individual debt grew too large. Farmers lost their land. Without land, no farming. Without farming, armies could not march. So they issued debt jubilees. Every few decades, all obligations erased. Not mercy. Structural maintenance. Medieval Europe added usury laws. Interest on loans was declared a sin across kingdoms, from England to the Italian city-states. The reasoning was mathematical. Lend 100 coins at 10%. In 14 years, the debt has quadrupled. No harvest grows that fast. No economy keeps pace indefinitely. These limits existed because societies had already watched what happened without them. Systems collapsed. Revolutions followed. For thousands of years, debt had a release valve. Then one Scottish merchant removed it. This is the first mechanism. Sovereign debt as infrastructure. Before 1694, lending to monarchs was dangerous. Kings could die. Successors could repudiate debts. Edward III defaulted on Florentine bankers in 1340 and destroyed 2 of Europe's most powerful banking houses in the process. Paterson's innovation was not the loan amount. It was the backing. The debt was secured by dedicated tax revenues, not a king's word. Specific, enforceable tax flows, continuing regardless of who sat on the throne. For the first time in European history, a government bond was safer than land, safer than trade, and it paid forever. The mechanism changed what creditors wanted. When interest payments are indefinite and state-guaranteed, repayment becomes a problem, not a benefit, because repayment terminates the income stream. In a world where reliable returns were scarce, that was a serious problem. Creditors stopped wanting their money back. Britain adopted the model, then France, then Prussia, then the United States. By 1900, perpetual government debt was not a crisis instrument. It was the foundation of global finance. But then the mechanism moved somewhere new. This is the second mechanism, debt as a product. Before the 1930s, mortgages in the United States were short-term, 5 years, 7 years. The Great Depression changed this. The federal government introduced long-term mortgages backed by government guarantees. 15 years, then 20, then 30. Low monthly payments. Decades of interest income for lenders. Home ownership rose. Consumer debt normalized. Credit cards emerged in the 1950s. Student loans grew rapidly after 1980. Then modern finance took the final step. Mortgages were bundled into securities. Investors did not own the houses. They owned the payment streams, the monthly interest, the scheduled transfers from millions of households. This is securitization. It started with mortgages in the 1970s, then auto loans, then student loans, then credit card balances, pension funds in Tokyo, insurance companies in Frankfurt, sovereign wealth funds in Abu Dhabi, all holding debt as an asset. Hundreds of trillions in institutional savings now depended on debt continuing to exist. But here's the problem. When that much of the global financial system depends on debt performance, what happens when it breaks? 2008. Subprime mortgages. High-risk loans packaged and sold as safe securities. When housing prices stopped rising in 2006, defaults mounted. By 2008, banks were collapsing. Governments did not absorb the debt itself. They rescued the institutions holding it. That rescue had to be financed through bonds. The same institutions that had held the failed securities now bought government bonds instead. They needed yield. Governments needed buyers. Neither could stop. This is the reinforcement loop. U.S. federal debt stood at $10 trillion when the crisis began. By 2021, $28 trillion. The system no longer required a decision. It subtracted alternatives mechanically. Every crisis expanded the debt. Every expansion created new holders. Every new holder had an interest in the debt continuing. That's when the question stops being abstract and starts being personal. And if this sounds familiar, it should. Global debt in 2023 exceeded $300 trillion, roughly 3.5 times the total economic output of the entire planet. Your mortgage, your car loan, your student debt. Normal people need it to finance their house, their education, their life. At every step, someone collects a fee, a spread, a return. Not by recovering what was lent, by making sure it is never fully repaid. Patterson understood this in 1694. The model he built did not stay in England. It became the operating system of the modern economy. The question is not whether $300 trillion of permanent obligation is sustainable. It has been sustained. For 3 centuries. The question is what happens when interest payments outgrow the capacity to service them, when the income stream that institutions depend on starts to break, when governments that cannot repay must choose between defaults, inflation, or collapse. History has seen all 3. It has never seen them at this scale. Debt is not a problem waiting to be solved. It is a system designed to persist. The institutions that hold your savings hold debt as their asset. Understanding that is not pessimism. It is financial literacy. And in the system Patterson built, literacy is protection. $300 trillion. Built on a deal made in 1694. That's not history. That's the room you're sitting in. If this gave you a new perspective, hit subscribe. There's more where that came from.